Okay, so I just got off work and I'm so not prepared for this. Like, where is it? Okay, here. Wherever I think we've done like the EBIT, the depreciation and capex and tax. Let's do net working capital. Right, we haven't got this one down. Okay, working cap. Let's see. Inventories. I think we need a receivable nets. Okay. So, well, to be honest, I forgot the meaning of net working capital. I just know that it's current assets minus current liability. So I'm just assuming something, converting cycle, how you're able to sell and pay off your debt with the sell. That's pretty much it. But let's just look it up. What is it? Oh, okay. Yeah, let's just look it up. Okay. It's the difference between a business short-term assets and its short-term debts and liabilities, I see. So basically, receivables minus payables, that's it. Positive net working capital signifies that company financial obligations are met and it can invest in other operational requirements. Okay, so, yeah, let's do it. Receivable net. So basically, receivable net mean account receivables, like when you sell in credit, and net mean you minus it with what you expect to probably lose on that credit. Like they might bail, they might not pay you for the goods and processes that you provide. So like receivable minus impairment loss or something like that. I don't remember the name, but yeah, that's pretty much receivable net. And mostly, most of the time, the income statement would, no, the balance sheet would like the percent, the receivable that already nets. So, receivable nets. I'm just gonna got it from here. Loan trade account receivable nets. See provision here. It's called provision. Like what you like expect to you that you might lost. I'm just gonna use this one. Receivable nets in 2018 starting. Right? Got okay. It's 249. Ship. Oh. Oh yeah. And then. This is how you calculate days receivable, number of days that you expect to receive the cash back from your account receivable, like after they purchased the product. So around 50 days, and this one I just do. Wait. Here. So I already got the formula down here. Yep, 360, then average of like the two beginning ending period, right? And then divided by sales. Like how many percentage of the sales are receivables, or like credit sales. And then we would average it out because it's quite almost consistent, I would say, like at around like 50. But I think it's just rather low, so I'm just gonna pick up the number at 50 here so that we're quite conservative here. Like just assuming that they might have like increased sales in the future, so it should probably have higher days receivable, but not too high. I think like 50 is a good number. And then we would forecast this thing with here sales, number of days. Okay, that's how we project current assets, the receivables, and inventories. I think it's pretty much just the same as, yeah, almost the same as days receivable. Inventories total. Wow. Okay. Here, yeah, pretty consistent. Oh. Well, let's just see 40. Yep, let's do it, like route it up. Prepaid expense, usually these are small. Like, I personally, if I don't have the time, I wouldn't bother, adding this line at all, but it's already in the model, so let's just do it. You like this line, prepaid expense, and like accrued taxes, it's just so small that you can just leave it out. But if you're thorough, then you can add it. Prepaid expense, another. Like maybe you pay rent in advance or something. Here, see, they don't have anything prepaid expense, so I'm just gonna leave it. All right. Working cap, like 0. Yep, 0. And here we have the total asset, like the sum of all these things. Why would I why would I do this? This is not the formula. Well, yeah, I think it's okay. Yep, I mean, it's correct. Account payable. So usually with the liabilities part, we do it a little differently from like we calculate the current assets for net working cap. Like when you calculate for like days receivable, it's like the number of sales that are on credit divided by like total sales. But for account payable, like any liabilities at all, you would divide it by cost of operating like COGs, which I don't know why, to be honest. I haven't quite gotten their understanding to this, but let's just look it up. Days payable. Days of payable, average number of days it takes to pay it back. Oh, yeah, they kind of look at the number of days it takes to pay back account payable as like a cost, maybe a cost of operating. That makes sense. To pay bills and invoices. Okay, that makes sense. Yeah, we got it from the balance sheet as well. This one, accounts payable. This is non-current assets. Trade account payable. Okay. Accrued expenses. Trade account accrued expenses. I think. Well, the thing I have to. Just this one. Yep. Okay. Accrued liabilities. This is the accrued expenses. Accrued expenses. They have more accrued expenses than account payable, which I don't know if it's a good thing or not. But let's just looks interesting. Income tax payable. Let's just do it. Accrued taxes. Accrued taxes here. Well, it's pretty high. Like I've never seen. Oh, this is that's not a ballpark number. This is like a number that I make out. Average of 3 periods. Okay. And then we got the total current liabilities. And this is the total operating working cap, which is current asset minus current liabilities from this period and that period. And the changes is that you subtract the current period by the previous period. That's it. Like you go on and on. And you can just plug this line into our DCF analysis. Working cap. That's a good number. Alright, so we still get the I still need to fix all these assumptions. Well, let's see. Current price, upside. Yep. Let's see. We need to find out about the WACC. And any company have specific cost of capital. It depends on like how much debt and equity they use to fund the firm. So basically, if you have really high equity, then the cost of capital expected to be like much higher. And yeah, usually like most company would have lower cost of debt than equity because it's cheaper to fund your firm with debt than equity. Like, I think I need to work more on like explaining this concept and even try to understand it myself because I don't understand it well enough to explain to other people. Like when I learn it in college and I take classes, I feel like I can understand it just fine in my head, but when I have to explain to other people, I just don't know how to. But yeah, let's get back to that later. Or we can do it now, right? We're doing a learning lesson together. Cost of equity. Let's see. WACC cost. Is it cost of debt is cheaper than cost of equity? Like this is a fact, like a philosophical fact in the finance world. Yeah, exceeds the cost of debt. The risk is greater to lenders. The risk of shareholders greater to lenders. I see. So, cost of equity, it's like what the shareholders expect to pay when they invest in a company, right? So usually, shareholders would get paid what was left over after they pay off debt. So let the debt holder have the priority in receiving paychecks. So yeah, I think that makes sense that the risk to shareholders is greater to lenders than to lenders. Yep. Comprehensive comparison sales and white debt is the first reasons. Primary reason that this comes without tax. Yeah, like when you finance your firm with debt, the debt, like the interest expense that you pay every single year, it's tax deductible somehow. Like I don't know why or how, but like it's just the law. I think I need to look into the regulations. Yeah, that's pretty much it. If they're higher than the cost of since the take on more risk. Yep. Yeah. So basically, just more risk, higher return. That's it. Well, let's see how we calculate the WACC here. The risk-free rate, usually we would use the government bond from each country, and it depends on the country that you're in. Like the 10-year government bond in my country, Thailand, I think it's more traded, I would say. We used 10-year instead of like 5 or 2-year because it's traded more often than the others. I don't know the word for it, but yeah. And since it's like it has higher liquidity, then it reflects the returns that the bond holders expect to receive. So it makes sense to use like the 10-year gov bond as a risk-free rate, the 2% risk-free rate. And yeah, usually we would go to like the website, Thai BMA, Thai Bond something association. Yep, Thai BMA government bond yield. And you can use like whatever just come up on here. See? So like the 10-year TTM time to maturity, you see, like you can just pick any bond, like 30 years to maturities, 90 years to maturity, something. Yeah, for the 10 years, it's 2.9924. Let's just 2437. It's 3%. Let's just say. See, so it's average out at around like 3%, like most of the time. So it's kind of expected. That's why I plugged it there. Market risk premium. This thing I got from like the CAGR, the compounded annual growth rate of set return index back 10 years. here. It's the data that I just retrieved from Refinitiv. So basically you find a CAGR, and this is like the most basic formula for it to calculate the CAGR, and like the last period divided by the longest period back 10 years ago. Yep. Yeah, the latest period. Oh, this is not really. Wow. Oh, okay. I don't care. Let's just use this. And yeah, 10 years minus 1. And we get 6.97% as the market risk premium here. And then we get the beta. I would, like, if you have the time and energy, you can regression and like lever the beta by yourself, but I couldn't care less. Like, you can just plug in any number between 0.8 to 1.2, 0.3. It's usually around that, if like, especially in the manufacturing and like food and drinks, which is quite defensive. It's just kind of perform within the market. And yeah, let's just plug in for now 0.1, 1.2. To explain a little bit about like the meaning of beta, and to also remind myself, because I'm a dummy. Beta in finance, what does it mean? Let's see. Meaning formula is measure the velocity of a security or portfolio compared to the market as a whole. Yeah, like, so if the beta is close to 1, like it could be less, it could be more, it means that it's perform as volatile as the market. I don't know if that's a good explanation, but yeah, look it up. But like, if you have a really high beta, then you would expect that you are much more volatile than the average stocks in the market. And like a really low beta, you don't really go with the market at all. But usually when you have like the company that has like a really low beta, I haven't counted this before, it's usually a really small cap stock with like free float less than 20% or like something. Yeah, because it's not traded too often. That's why like the stock price doesn't move too much. So they have like a low beta. And yeah, I think that's what I understand about beta so far. I'm just gonna look up beta for SAPPE on set, I think, because I'm just too lazy to calculate it myself. Like, if I have the time later, if I have like the energy to do it, I might do like a video later on about how to regression your beta. But for now, let's just do this the lazy way. Beta 5-month yearly 0.66. It's not very ideal. I want like a 1 or something. Or adjusted beta calculation, long-term bond rate, max premium, adjusted beta. Let's just use 0.8. Maybe use 0.8. Or 1.14. Oh, let's look at English. Okay, so that everyone can see. Oh, no. This is how you quote. Get a quote. Profile. No, not financial highlights. I need a profile. Company summary. That's it. See, so like the blue line is SAPPE, and set is like represents the orange line, and the last blue I don't know what's the color, the turquoise, like the last blue one, it's like the food industry. So let's see, so it's pretty much in line with the market and the industry like in the previous period, but then they started to outperform since 2019, which is quite a phenomenon, I think I would say. Oh no, like, so this is when COVID hit, like the news in March. So basically, I looked it up, like every single stock, not every single one, but like most of, like about 100, and I found out if you if you bought in like March 2020, you would be like, you can retire by now, like, because most stocks just like go down, like, because it was like a shock, COVID shock, and then it could just kind of come up back to its valuation. And right now I think it's kind of overvalued, but let's see if it's or not. Yeah. Beta law 1.13, 2021 1.6, 1.06. Year to date, yeah, I would say 1.13 to be the most recent. So these are the cost of equity. It's basically CAPM, like if you heard it. So the risk-free rate, see. Oh yeah. Oh yeah, cost of yeah. So risk-free rate, plus beta plus risk premium minus risk-free. Yeah, it's basically CAPM. Cost of debt, I'm just gonna use like net debt, short-term and long-term debt, and interest expense. Let's see. Debt, current liabilities, short-term and current short-term debt, long-term debt. Okay, I think it's this one. Oh, they barely have any debt, so it's like quite a conservative company. I bet they don't even have interest expense. I think I remember like they only have like interest income. Let's see. Net income, interest expense. Okay, net of interest income. Financing income. Okay, I'm just gonna use this line here. Yep. They only have like interest income, and I don't know, how do we fix this? Like, how do you adjust when a company don't have any debt? Interest expense, income. Yep, because like the income exceed like the expense, so it's a minus. Well, I don't know. Let's look it up. Cost of debt when the company is debt free. There are a couple of different ways to calculate it because of that. It's not very common for a company to be debt free, or I don't know. Oh, I mean it's common, but like in Thailand, like in other countries, I don't think it is. Cost of debt. I don't know how else to do this. Invest cost of debt. Guys, do you have any idea how to do this? I don't know, I'm just gonna give it a ballpark number. Yeah. So we're left with, no, I need to debt year end tax 20%, stock price. Okay, stock price. We have ventures outstanding. I think it's in the balance sheet, right? Share outstanding. Number of shares, yeah, here. Shares outstanding in this year. And then equity value, yep. The equity value is the market value of equity. And then we would have that DE, right? 7.47. Unlevered free cash flows, okay, the last year. Growth rate, terminal growth rate. Okay. 3% terminal growth rate. And oh, are you serious? This is quite high. I don't want it to be this high, but yeah, it might be that the company is undervalued at the moment. Or I might have adjusted for like a too high the revenue. Like at first I was just I watched some YouTube video, like the update presentation, and the CEO said that she expected the sales to grow like 10 to 15% with the very next 4 or 5 years, and it's very unusual. It's quite unusual, but I mean, I don't know, they might be able to do it or they might not. But yeah, I think 5% is pretty conservative. We never know what's gonna happen, right? But like, I really do believe in, you know, their ability to expand internationally. Or this might be SG&A margin law. Yeah, I mean, if they expect to grow, I would, yeah. Okay, let's increase it a little bit, EBIT. And so we have less EBIT. And then, yeah, I think that's all pretty much what we can do. I don't know, like the capacity expansion. Oh, like I remember they say something about building a new factory in 2024. So we can maybe increase CapEx a little bit in this year. CapEx as a percentage of sales, maybe 10%. Still pretty low. I don't know, 30%. 30%, yeah. Okay, so yeah, I think it's more reasonable now. Total present value of cash flows. Yep. And yeah, no, I forgot to explain about this part. So basically, when you got like the total unlevered free cash flow by, you know, calculating by EBIT plus like you added back depreciation and amortization, because this is the amount of cash that you pretend like that you pay out in the cash flow statement, but actually it's just like an accounting adjustment. It's not like actually the cash that you pay, so you add it back, and then you you minus changes in the working capital, minus capex, because you know this is the money that you expect to pay to invest to expand your business, and you pay tax, of course. Yep, 20%. And yeah, that's pretty much how you got the free cash flows. And every single year you just have to discount back with WACC here that we got. So we discount back this period 7.47%. See? Yep, it's just discounting. And then you get the total net present value, which is the sum of all the cash flows in the future. And yeah, this is pretty much what you got. Present value, terminal value. Net present total, net enterprise value. Yeah. Oh, net debt. Lob cash. Yeah. Yeah, I would say I wouldn't. minus cash. Net debt. This is supposed to be net debt, which is like all the debt, minus cash, because you expect to pay everything before you give to the equity holders. Yeah, but let's not do anything with this. It's quite pretty high. Like if I subtract the cash from this, then it'd be a negative number, and then it would add out to like the real equity value. Share count millions. Estimated equity value per share. Wow. 41.2. I think it's 20% upside. It's pretty high. Like 1 year from now. But I think it's doable. Yeah. In case something happened next year, like we don't have any other disease. Yeah, I think I'm just gonna go with this one for now. Or we could add something with the capex. No, but honestly, the thing that makes like the equity value the most sensitive, it's the BACC and the growth rate. Well, we can adjust these, and like the target price would change considerably. The BACC, maybe I could. I think this is the reasonable number. 1.13. Let's say the economy is bad next year, or we're going into recession or something. I should have some worst case, and base case when doing this kind of analysis, but I'm just too lazy to do it. But yeah, but always I would go with the conservative approach, because I think it's more convincing, right? Like when you try to project the company to grow at 5%, 10% every single year, it's kind of impossible. I mean, it might be possible in something avant-garde, or innovative, in tech or in energy, in anything futuristic. But for foods and beverage, yeah, it's pretty much single-digit growth every year. And 5% is pretty high. Yeah, so I think it's just gonna go with the conservative approach, and 9% is, I don't know, 2.5% GDP growth. Let's just look at it right now. Thailand GDP. Terminal growth 5 years from now. It doesn't have to be the GDP. It's just kind of the rate that you expect the company to grow for eternity. Because 3%, I'm just gonna go with it. See, I change it by 0.5%, and it changed by 10% for the upside. So let's see the market life cycle. I just want to explain a little bit on the terminal growth rate concept from my own understanding. The company life cycle, maybe company life cycle. Yeah, I mean, I think everybody have seen this kind of graph before. So it's almost it kind of applies to most companies. At the first stage, you launch, you grow, this stage applies to all the tech stock, and eventually you would mature, and you flat out. So this mostly all foods and beverage, the energy, materials, industrials, the staples, all the not so sexy sector out there. Yeah, and I think the food and beverage falls behind this one. So you can't expect to grow this much, this high, always, all the time. So eventually you would even though you can project the company to grow like 10% this year, 5% this year, 20% this year, but like in the long run, it's usually like low, 3%, 5%, depending on the economy state. So that's why we kind of used GDP to calculate, to represent the terminal growth rate, the rate at which the company might grow for eternity. Terminal growth rate. Concern is to grow at forever. See, so at the end of the last year's period, cash flow then goes into perpetuity. Yeah, that's pretty much it. The modeling, and I might do another video if I have the time to, explain a little bit on. Wait, where did I put it? Here. What I think about this. Oh, and should do financial analysis, the ratios. I forgot. Oh, but actually I have it, right? The investment risk. Yeah, I should lay out all of these. I already got this part down. Evaluation. For this part, I can just watch videos because I'm just too lazy, and maybe look at other competitors as well. But so far as I see, like SAPPE is one of the very few companies that like can operate and still profit during COVID and like have like positive free cash flows over the years, regardless of the economy. And I think it's just really great that a company can do that when others are falling down. Yeah, that's pretty much it. For those of you, whoever is watching or might not, thanks. Bye-bye.